Welcome to Market Overtime. I'm Oliver Renick. Today we have the treat of sitting down with one of the smartest folks in the Schwab investment universe. It's Omar Aguilar, the CEO and Chief Investment Officer of Schwab Asset Management, and also the head of the Schwab's Center for Financial Research, where of course we source a lot of our intraday guests here on the Schwab Network. Omar has also been a long-term source of mine as a reporter from some of the earliest days in my career. Omar, it's great to have you here. Thanks so much for taking time to chat with us today.
Hi, Oliver. Good to see you, and great to be here.
Likewise, appreciate that. We get a little bit more time today, so we're going to talk some markets, obviously. We'll talk a little bit of some of the stuff in your realm from behavioral finance. I know you guys have done some good surveys recently of clients, and I want to know what's in that. Let's start with the near term and talk about where we're at in equities as we record today. We're making all-time highs. We got a pretty good-looking inflation print. We're just waiting to hear from Jerome Powell. How does it look generally from an asset management perspective on the overall environment?
Yeah, well, we continue to look at this, Oliver, as the path to the long-term, inflation numbers that the Fed has been looking for seems to be moving in the direction they want. The way that we think about it is that inflation is sticky, but it's not stuck. I think the CPI number that we saw today basically just showed that we continue to make progress towards getting that, incredible disinflation that everybody has been working on. And the markets seem to be reacting to the fact that these will provide more opportunities for the Fed to make the decisions they need to make. There's no question in our mind that there was not going to be any decision into today's, announcement, but certainly the probabilities for one or two rate cuts before the end of the year are now much, much higher, starting potentially in September.
How much in your mind does strategy and investment portfolio construction depend on a clear outlook for the Fed, Omar? Because a couple of years ago it seemed like we were very much reliant on the Fed. 2022 was brutal as rates went up, stocks went down, and the whole portfolio fell apart. Have we graduated away, matured away from any of that dependency in your mind?
Yeah, 2022 was a weird, year where, nothing actually worked other than sitting in cash, waiting for, as you said, for macroeconomic and central bank decisions to drive, how the investment outlook is. I think we're in a very different place right now, where we have now gone through a place where we know what the path is for interest rates. We don't know the timing, but we know what the end goal is, and therefore, making a strategy and making investment decisions that focus on what is going to happen, over the course of the next 2 years, seems to be more realistic. So when we think about that, the chances that the real interest rates stay where it is very low. What that means is that as inflation comes down, the Fed reaction has to be to lower rates, and therefore the shape of the yield curve will be more normal. And as we continue to see normalizations of the majority of capital markets, then opportunities for setting up portfolios that tend to look more like the traditional normal strategies seem to be more reasonable.
That's really kind of the key point, is how much can we assume that things return to a more kind of cyclical nature of markets after COVID threw things into a very odd kind of tailspin of zero rates and then this steep rip back. Do you feel, Omar, that generally kind of looking at history and thinking about traditional cycles and building portfolios will start to work more effectively from here? It kind of sounds like that's an argument.
Absolutely. If you think about it, this goes actually even pre-COVID and all the way back to the great financial crisis, where obviously, getting into the process of having artificially low interest rates and then going into COVID where that has to be even more emphasized, basically got us a period that was very anomalous. And that means, having no interest rates and in parts of the world in negative rates was such a difficult, environment for just creating investment opportunities for clients, because as we saw for a decade, it was only one option. That was the whole TINA. There is no alternative to equities. Now we have gone past that, and when you actually see these, the probability that we're going to go down to a level of interest rates of 0 or below, it's very, very low. What that means is that the opportunities for diversification are much bigger now than they had been in the last 15 years. And what that means is there's opportunities to invest in cash, there's opportunities to invest in fixed income, there's opportunities to be in equities, and I would even say beyond just the US, even international, because markets have become more normal as we continue to go to a more traditional economic cycle.
That's a really important point. I do want to talk about the internationals. I was just thinking about that, but to kind of follow up on that, the nature of the COVID forcing us towards that zero bound that many thought was kind of inevitability. It's almost like we got it out of our system. Like we went to that extreme. We went to that end of the spectrum. Now, as we think about that and its role for central banks, we've had this big lift off from the zero bound the other way. Do you feel, Omar, that as we talk right now, there are still deep ramifications lingering from the way we came off that zero bound? So many are still looking for lagged effects, or were they just what happened in 2022 and we can move on to something a little bit more strong and stable?
Well, we're not completely out of that framework, and I think, yeah, the lag effects of just this, even just the move towards increasing 5% in the Fed rates, obviously still, trying to make its way in through the economy. And I think as we're seeing already, we saw an increase in inflation that has been, in the process of unwinding. And I think as we're starting to see this, we see even the behavior of consumption being more normal. When we're starting to see the different parts of the consumer that actually make an impact into GDP, now we're starting to see more normal behavior when we see the different parts of the consumer spectrum behaving in a more normal fashion. And that's also as a result of wage growth. If you actually think about wage growth for the last few years, basically, was incredibly fast, and now it's moving down to a more traditional wage growth that is consistent with potentially, a little better in terms of consumption pattern. I think, as you well pointed out, a lot of the consumption that ended up leading into higher inflation was as a result that we were all stuck at home and we wanted to go back and start spending, and therefore there was a very furious and fast spending spree that happened as consumers had very strong balance sheets, and deploying that cash in terms of consumption ended up creating that inflationary piece that we are now in the process of unwinding.
So much of that, too, even though the whole world kind of moved in tandem around the pandemic, the U.S. is the one that maintained that impact of the COVID rescue policies plus the boom in the consumer to stay above trend. And now we see that as our own central bank is still kind of stuck waiting, while a few of the other big ones are getting ready to cut rates. It's already been a pretty good year for international stocks. How much do you think investment managers need to think about that rate differential and including international companies, and where does that now play a role in the portfolio? Should it be bigger?
Well, it is definitely an area that has been underinvested, for years, and it is clearly, for a reason. The U.S. economy and U.S. markets were clearly the leaders, over the last decade as we went through, the recovery from the global financial crisis and into COVID. But it's interesting right now because, for the longest time, most other central banks were basically following the path of the Fed. And what we see, and as you well described, is that we're now at the point where the Fed is still in the initial parts of reducing rates, where other central banks have actually already cut or are in the process of cutting. And what that actually also means is that their inflationary structure has actually gone faster, lower, than what it has been in the United States, which creates other set of great opportunities. We see a strength in the dollar as a result of that interest rate differential. But even when you put it into dollar terms and adjusting for dollar terms, the growth that we can see in developed markets, and particularly in Europe, Japan, and the UK, seems to suggest that the opportunities to invest in international markets are still, available. If you look at valuation and relative valuation between what we see in the average stock internationally relative to the average stock in the US, we see that opportunity is still favoring international markets. Now, if you take out even the Magnificent Seven and the concentration on the seven most expensive stocks that we have in the US, that still provides a good opportunity for investing internationally.
The trade, maybe since the U.S. is so concentrated, or the investment is to, I guess you can't really fade those given how powerful they are, the Mag 7, but if the rest of our stocks lag behind, maybe some of that shifts over to international. Is it a trade-off, Omar, or if the international piece of one's portfolio puzzle is bigger now, does it come from an alternative replacement? Does it come from maybe where you had been parking things in more risk-off assets, or is it kind of a pure U.S. trade-off And if that's the case, is there an implicit challenge for the investor to make sure they don't back away too much from a very tech-heavy sort of revolution that's happening?
Yeah, well, it is an interesting, concept. Just by pure market appreciation, majority of client portfolios are now overweight U.S. and overweight
right.
tech. Just by the fact that, without even doing anything, it is very healthy as you think about rebalancing to try to find of those areas where there's been underinvesting. And in this particular part of the cycle, as I described, this is a great opportunity as they find opportunities to rebalance portfolios to try to take, some from the highly appreciated asset classes into areas that are underinvested. That includes, international markets. The other piece that is important to say is that, most people have asked me in the past, is this a bubble that is happening, and at some point that extra part of growth will basically fade away? And a big part of what we describe is that these 7 companies, or in general, the growth companies, the technology-heavy companies in the U.S., are a result of them being higher quality, very stable, free cash flow generated that continues to generate earnings. And a lot of that includes just a very simple ecosystem where they are investing in technology, they're investing in AI, they're investing in their capabilities to generate free cash flow, and their balance sheets are very strong. So it's not surprised, to all of us that all of a sudden you see that amazing growth that they have seen in prices, mostly as a result of their business model seems to be working really well.
It's a higher quality trade, right? By just kind of financial definitions, especially if we compare to like a COVID trading period where it was a little bit more manic. Valuations were still far exceeding where they are today. So does that make this a little bit more palatable? Because I would imagine it's probably the main subject that you deal with clients right now is they go, look, I never intended to have my portfolio this concentrated, but now it is.
Yeah, absolutely, and I think a big part of that is that yes, the concentration, mega cap concentration, growth concentration, technology concentration is something for clients to be aware, so that they have to find that extra layers of diversification. Again, fixed income, international, and so forth. But what we're trying to just overemphasize is to say that diversification and try to just have the right exposure is great. But the fact that you have this exposure doesn't necessarily have any negative effects for the long term. In other words, you're basically well positioned. If you have exposure to those, you don't necessarily have to take it away. It's true that the earnings growth and the EPS growth possibilities for them to keep the same pace is very hard to sustain, but the ability to have them is actually a great piece of it. Now, it is important, I think you mentioned behavioral finance there, that in many cases clients tend to see a lot of information and the recency biases, which is the ability for them to focus on the most recent information, seems to create them the illusion that they have to put more into that, and that's a little bit of what we're trying to work with them with our Center of Financial Research, is to understand that you don't necessarily have to double down because you already have a lot.
Right. So kind of think calmly and measured and with longer term themes in mind. Omar, when you look at that conversation with clients right now, it seems like too, just going through some of your guys' data from a recent report, that there's a few gaps in some of these questions between retail investors and advisors, to where for the most part they kind of see eye to eye on things, but in a few instances there are some gaps. And to the point about tech as one of them, just looking at how tech stocks will lead markets, there's a little bit more doubt, it seems, on the individual investor side, whereas the advisor maybe has gotten a little bit more used to kind of just embracing big tech as the leader.
Yeah, and Oliver, it's interesting because the conclusion from the survey, it starts by saying like there's a lot of alignment between clients and advisors, and that's not always the case. But in this particular, there seems to be a general optimism both from the retail client as well from the advisor that things in the economy and markets continue to be in the right place. Second, advisors are doing a good job. They are looking holistically about diversification. If there's any difference between retail and advisors, seems to be in just investing investing in equities, investing in tech, whereas advisors are emphasizing the move to fixed income, the increase of duration, in anticipation to the potential changes in Fed policy. Whereas retail investors are still, more heavy into equities, heavy more into this idea of recency biases, of trying to just be affected by the most recent observations of all-time highs for these stocks and, the AI frenzy. What is also interesting about this survey is also the fact that when you actually look at, whether or not tech is going to continue to drive, advisors seems to be more holistically looking at, well, these are good, stable, generating cash flow companies that they should have exposure, and clients therefore, could benefit from it.
It kind of seems like on the individual side, there's a little bit of that recency bias where it shows up, and they see stocks going vertical in price, and they say, okay, I saw this with some of the bubbly stuff in COVID, but as we just mentioned, this is a different in a lot of ways, in some really important ways, like a stock like NVIDIA that runs, and then its earnings valuation for some period there was actually going sideways while the stock was going up. Very different situation if your growth and your earnings are booming. So when you kind of put this together from a mission standpoint, Omar, how does that inform what you guys do when you want to communicate with the individual investors? Because I see a lot on the survey, there's uncertainty that a lot of the individuals have. I noticed that the responses on the advisor side, they usually fall into one of the kind of main options, that answers to the questions, whereas a lot of times on the individual side, there's a good bit they go, I'm not sure, I don't know.
Well, the first thing we normally tend for individual investors is precisely because there is a population that do not know what to do. The best thing to do is to talk to an advisor. The best thing is to talk to your financial consultant to try to get some guidance into, how to actually look into this. Now, at Schwab, we provide a lot of tools and a lot of education for people to try to look on how to navigate information, but we also understand that, information overload is overwhelming. It could be overwhelming for the retail investor, and how to distill the amount of information to make the right decisions, at the end comes down to what is your long-term investment objective. And I think a big part of our job, given everything that is going on, given where interest rates are, where earnings go, where we see international, when you see fixed income, when you see duration, the whole complexity of investment layout goes back to what is the individual client investment objective and what is their time horizon. And when you put those two together, then the definitions on how are the next things you have, there are certain things that we know philosophically will work. In the long run, staying put with your strategy and not making trades, trying not to time the market, always lead to the best possible outcome for the client.
And Omar, thinking about the fixed income alternative now that's there, for a lot of clients it would seem to be the case that getting that kind of 5% they can get right now without taking a lot of risk and locking in has changed the equation, namely two. Does that kind of depend on one's age, one's outcome? Do you see that the offering now from the fixed income market pushes people to just say, you know what, I'm going to make this decision easy. I'm going to lock in 5%. And right now I can even do it on a short-term horizon. Well, it is a question we get a lot, and which is like, well, why is that we need to actually think about anything else where you can actually get a 5% or higher, on a, cash vehicle? And I think what we try to just emphasize is that there still exists the equity risk premium, and the equity risk premium hasn't died. And what that means is that, first of all, the 5% that you have in the short-term instrument is not going to be there forever. And I think a big part of our education, today continues to say that we are emphasizing, the fact that, slowly clients need to start deploying that cash into increasing duration on their fixed income portfolios, or potentially even just going to use that, cash to, get some of equity exposure. Because again, as you think about, reinvestment risk, and reinvestment risk defined as that, those instruments today, when you roll them and you try to reinvest them, 6 months down the road, they're not going to be at 5%. But if you want to stay with that 5% or higher, if you go to intermediates, if you actually go to some of the high quality bonds, you can still get that 5% you have. It's just you need to increase a little bit of the duration, and it's starting to do it right now. And again, timing wise, it's just a matter of time when we actually see that normalization, or at least reduction on rates that you have on the short end, mostly driven by the Fed. At the same time, what we're trying to just emphasize clients is to say that, well, and the opportunity cost of being at 5%, it is that
you're not necessarily having exposures to this megacaps, you're not having exposure to international, that in the long run, you want to make sure that you have a combination of all the pieces. What is great about it is that, again, for the longest time, we didn't have those 5%. We didn't have anything coming out of bonds, and therefore having the ability to just talk about it and having the ability to have a portion of your portfolio in fixed income is something that is welcome for an investment perspective.
Optionality, right? Always generally welcome. When you think about some of the other themes from an advisor standpoint, Omar, I'm curious from your perch, do you look at any of this AI stuff in development and think about its role from an advising perspective or from a manager perspective? I mean, on the one hand, there's now, it's easier to code things, develop things for people to kind of write their own bespoke quantitative strategies. There's also potentially robo-advisors that have always kind of lingered in the background, but like now that we've actually got real tech that kind of mimics conversations, do you see it disrupting the space?
Yeah, it is kind of amazing, the kind of AI and what we're witnessing already. And I think what is more interesting, and I think this is part of what at least our views are, is what is more interesting what we haven't seen. Because a lot of what the current version of AI that we can see and use, it is probably in the early stages of what is already been in the lab and what you can actually see in the next few years, which is kind of exciting. And what that creates, we normally think about AI in this case, which is definitely a change in the structure. We're going in through a place where the U.S. economy for the last 10 years have had one of the highest levels of productivity that we have seen in a long time. Mm-hmm. And what that actually does is AI will just continue to increase that level of productivity within the structure. If you think about the time that you can actually even have to write a document, you can actually save a lot of time by just starting off with AI. Now, what I think we try to do in the context of investment management and the concept of investment and advice is to basically say that at the end, you can actually use that as a tool, but it's very prudent to basically always have somebody as a human that can actually allow you to actually know what it is going to be, the final investments in your portfolio. The analogy that we tend to use is that, when you jump on a plane, if you jump on a plane, there's going to be an autopilot, and that I would probably say 80% of the flight is going to be in autopilot, but you want a human to land that, plane. You don't necessarily want to rely just on the computers. Well, the, pilot is going to use a lot of the systems and a lot of information and a lot of things to basically make you rely on the experience of a pilot to be able to land the plane. And I think it's the same thing when it comes down to investments. You can use a lot of tools, you can use a lot of quantitative, a lot of models and a lot of things and a lot of AI that will provide you more information to make informed decisions, but at the end it is a human that is more equipped to make the right decision at the right time.
I love that analogy. I think it works pretty well. You mentioned something else in there, Omar, that I think is kind of a good way to bring it full circle here to where we started the conversation from a market perspective, the role of AI trying to assess what is valuation driven, what's true, disruptive, growth driven. You mentioned productivity in there, and what I've noticed in the last couple months is we've seen the market on a short-term basis move a little bit more around some of the productivity figures, and I wonder if you think watching those types of economic data over the next year, given AI's development, might that be a way for us to kind of gauge the veracity of AI's true kind of impact on the economy? Because we talk about it from stocks perspective a lot, but the economy, does productivity kind of lead the way for us to assess what impact this has?
Yeah, I would say, productivity, in terms of what the impact on the economy, and when you think about corporate balance sheets and, earnings, it is capital expenditures. I think when you think about, the spectrum of how much companies are going to spend in AI and AI specific technologies, that's a good way for us to see what is coming ahead. I think, in pretty much every industry, there is already initiatives to basically deploy versions of AI for their businesses, going from utilities, through consumer, through investments, through financials, to banks. There's already a big slew of, potential capital expenditures going into AI. And as you know, the capital expenditures usually, translate into higher ROEs, which translates in potential opportunities for investing. And so I think when it comes down to financial markets and investing, the AI capex and the AI ROIs is going to be an interesting thing to follow. And when it comes down to productivity and when it comes down to the actual economic impact, it is those areas where we're going to have. I really don't think, people seem to be more leaning towards, well, does that mean it's going to be higher unemployment? Does that mean it's going to take jobs? I don't necessarily think that's going to be the case, but I do think that higher productivity and a higher levels of impact on efficiencies will probably be gained.
All right. Omar, great stuff. Always love to get to tap in your mind and see the visibility that you have across the financial world. Appreciate your time here.
Thank you, Oliver. Always happy to be here.
Absolutely. Omar Aguilar, CEO and CIO at Schwab Asset Management. Thanks for tuning in to Market Overtime. I'm Oliver Renick.